Welcome back to Alpha Recap. Glad you could join us after the close. We're looking back at a busy March 30th, where geopolitics really rewrote near-term risk across sectors. As always, if you have questions, you can reach us at stockalpha.ai.
Good evening. A lot to unpack from a day that started with headlines and ended with very different winners and losers across the market. The markets closed mixed, and that tells you there were some clear rotation flows underneath a chaotic top line.
Right off the bat, the biggest story? Oil. There were reports of roughly a 50% intraday jump in crude, tied to Middle East hostilities, and that rippled across commodity-linked sectors.
A 50% spike in a single session is huge, even if just a short-term reaction. It forces people to revisit inflation assumptions and credit spreads immediately.
Totally. And the impact was pretty neat to watch. Utilities and renewables actually found buyers, while finance, cannabis, and crypto took the brunt of the risk-off flows.
Defensive and infrastructure-linked sectors rallied on the back of tangible project news. More on those in a minute. While sentiment-sensitive pockets got marked down.
Let's hit the data points that framed the day. And what really stands out here is the mix of real-world project finance and crypto flows.
Okay, start with the big project headlines.
There was a start on a major battery storage project in California, about $600 million. And BYD scaled battery energy storage systems, which helped the utilities narrative.
Plus, record solar output was flagged by the Energy Agency, which made the renewable story feel less speculative and more cash flow adjacent.
There was also a polysilicon supply chain financing deal, about $125 million, which underwrote solar materials demand, and a big data center capital raise of about $3.25 billion.
A $3.25 billion fund for data centers really matters. It signals continued appetite for digital infrastructure, which dovetails with the renewable power story, because these facilities want clean, stable power.
And on the crypto front, two contrasting facts. The Ethereum Foundation added about 20,470 ETH to staking overnight.
And Bitcoin-related ETF products recorded roughly $290 million of outflows.
Yeah, that tracks. The staking move tightens liquid supply on Ethereum, which can be constructive for network stability, while ETF outflows show how quickly risk appetite can reverse in liquid crypto products.
Exactly. And on a totally different front, New York reported about $3.3 billion in cannabis sales over 5 years, right as federal CBD enforcement chatter picked up.
That enforcement chatter rippled through cannabis names. There were state-level issues, too. Seizures in Arkansas, restrictions in Ohio, a lawsuit in Kansas. So the sector saw fresh uncertainty.
Short reaction.
Wow, that's big.
Not what anyone expected.
Let's walk through the winners. Utilities and grid tech were among the day's outperformers. Investors reacted to storage deployments, grid pilots, and that California project, and the idea of near-term revenue for equipment vendors.
Right, put simply, when you can point to contracted offtakes or pilot wins that reduce timing risk, the market rewards those supply chain names. Contracts, like power purchase agreements, give line of sight to cash flow.
Real estate and data center infrastructure also did well, for the reasons you just said. That big fund we mentioned provided an anchor for flows into REITs and infrastructure managers who can source renewable power for those sites.
Energy equipment and clean energy project developers showed pockets of strength too. Polysilicon financing, EV charging wins. Even though traditional upstream energy had its own rally on the oil move.
On the downside, finance and banking underperformed, as geopolitics and commodity volatility widened perceived credit risk. Cannabis and crypto were hit by regulatory and flow-driven pressure.
Short reaction.
Oof, tough day.
And honestly, I was a bit surprised by how quickly capital rotated into utilities and real assets.
That rotation makes sense if you think of renewables and storage as defensive growth. They offer a growth narrative tied to contracted revenue streams, unlike some of the sentiment-dependent sectors.
Now let's step back and talk cross-sector themes, because the headlines were connected more than they looked on the surface.
First, geopolitics and commodity price transmission. A big oil move widens credit spreads, pressures consumer margins via higher transport costs, and can change earnings assumptions for industrials.
In plain English, higher oil raises costs across the economy and can make banks more cautious on loans to commodity-exposed borrowers, which feeds through to lending standards.
Second, renewables plus grid tech equals a defensive growth storyline. Record solar output, the battery start in California, and BYD's deployments were tangible signals that renewables can drive near-term earnings for equipment suppliers.
That also ties into data centers as large electricity consumers. Investors liked names that can promise low-cost, stable renewable power to those facilities.
Third, technology and AI remain both catalyst and risk. We saw Apple launch a big product, Apple Intelligence, in China, and Realtor.com experimenting with ChatGPT features. But governance and platform experiments created offsets.
AI gives productivity upside, but operational missteps or governance gaps can trigger outsized downside. Analysts note that the regulatory prism is narrowing around AI deployments.
Fourth theme, regulation and enforcement. Cannabis, crypto, and specific healthcare subsectors were in the regulatory spotlight. That drove capital away, at least temporarily.
And fifth, fund flows and liquidity as transmission channels. The $290 million of outflows from Bitcoin ETFs highlighted how liquid products can amplify sentiment shifts across related equities and custody providers.
Let's unpack a couple of the significant moves and why they mattered. Start with the oil surge. Again, roughly 50% intraday. If that kind of move persists, it forces a repricing of inflation expectations and corporate margins.
Banks could see credit quality questions in commodity-exposed pockets, and consumer discretionary faces margin compression from higher transport costs. It's not just energy stocks that are affected.
Utilities and storage wins mattered because they offered visibility. Grid pilot successes and seismic test wins reduced operational risk and improved project timing, which feeds valuation multiples tied to contracted cash flows.
On crypto, the staking increase in Ethereum, about 20,470 ETH, suggests more active participation on the network, which can tighten liquid supply. But the ETF outflows show investor sentiment flipped in Bitcoin products.
For cannabis, that $3.3 billion of sales in New York over 5 years is a reminder of the sector's size, while federal enforcement chatter increases policy risk premium. That changes valuations quickly.
And the polysilicon loan and the aluminium plant geopolitical shocks point to concentration risk in materials. Sudden supply squeezes can pop inflation into input costs for manufacturers.
So what are the practical takeaways for listeners, purely informationally?
Reassess commodity exposure under scenario analysis. Run downside scenarios for sectors sensitive to transport and input costs, like discretionary chains, airlines, and certain industrials, to see how higher fuel costs affect margins.
Favor clarity of cash flow and contracted revenue where possible. Utilities with power purchase agreements, storage operators with long-term offtakes, and data centers with multi-year leases looked relatively better positioned in this environment.
Watch policy calendars and enforcement actions. Cannabis and crypto remain at risk of outsized moves if federal or state-level rulings roll through. Analysts note that court dates and agency memos matter more than usual.
Monitor fund flow signals in real time. ETF inflows and outflows, futures positioning and custody flows can be early warning signs of shifting retail and institutional sentiment.
And for tech and AI exposures, prioritize governance and compliance readiness. Firms with demonstrable governance frameworks and diversified revenue streams are likely to be less volatile if regulatory scrutiny increases.
Quick company callouts we saw in the tape. Apple launched a major AI product in China. Amazon leaned into device and fulfillment promotions during its spring sale. Meta tested paid Instagram features. And Netflix opened a big office in Warsaw for production.
Yes, film crews are headed east, apparently. Those moves are more about product expansion and cost allocation than day-to-day trading, but they fit into the broader themes we discussed.
Before we wrap, a couple of risk signals to watch into next week. Oil price persistence, central bank and credit market reactions, and regulatory calendars for cannabis, crypto, and select healthcare items.
Also, watch developer notices and offtake announcements for renewables projects. Those will confirm whether the storage and solar momentum translates into durable revenue for suppliers.
And a reminder, this is for informational purposes only. It doesn't constitute personalized investment advice or a recommendation to buy, sell, or hold any security. Analysts note that the data we discussed reflects market activity as of March 30th, 2026.
Final quick takeaways. 1. Geopolitics drove a big oil shock that repriced risk. 2. Renewables, grid tech, and data centers found tangible buyers due to project news. 3. Regulation and fund flows remain fast transmission channels for sentiment.
Clear, concise, and helpful. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be watching the oil path, EIA data, and the regulatory calendar closely into next week. Good night.